Welcome! I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today as we unpack the Corporate Alternative Minimum Tax, or CAMT as it's known, and discuss how certain provisions of the One Big Beautiful Bill Act may inadvertently subject more taxpayers to it. Today's event is another in Tax Analysts' series of public discussions we call Taxing Issues. We launched this series as another way for tax analysts to encourage debate on tax issues. We've been bringing the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy and administration. As always, we welcome your feedback on how we can make our webinars more useful, as well as your suggestions on future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Please use the chat feature to submit questions during the webinar. For our panel discussion, I will begin by asking a few questions, and then we'll integrate questions from you, our audience. I will get to as many of them as time and topic permits. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the poll questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comments section. To receive credit for your answers, you will need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you will not be able to see the questions if you expand the program to full screen. The course materials, which we sent out in advance, are also available for downloading under the viewing window. And now on to the topic of the day. Among other things, the One Big Beautiful Bill Act, or OB3, was designed to encourage domestic investment. To do that, it introduced some favorable corporate tax changes, such as restoring full expensing for U.S.-based research and development, reinstating 100% bonus depreciation for equipment purchases, temporarily allowing expensing for new U.S. manufacturing facilities, and loosening limits on interest deductions. Now, that all sounds pretty good for corporate taxpayers, right? Well, maybe. For most businesses, the changes will lower their overall tax bills and make investing in the United States more attractive. But every time we add new tax rules on top of old tax rules, we invariably cause some concern and confusion. As we sit here today, corporate taxpayers are still trying to figure out how OB3's incentives interact with existing tax rules, including CAMT, the Base Erosion and Anti-Abuse Tax, or BEAT, the new FIDE, interest deductibility limits, and the foreign tax credit rules and limitations. So let's take CAMT, for example. Now, before 2022, large companies calculated their profit in 2 ways, one for taxable income under the tax code, and the other for financial statement income, or book income, which follows GAAP principles and provides a better picture of their financial health. 2 different calculations for 2 different purposes. Then along comes CAMT, which added a 3rd way for corporations to determine their profit, which is called the Adjusted Financial Statement Income, or AFSI. AFSI starts with book income and adjusts it to reflect certain tax deductions and credits. Large corporations with average adjusted book income of above $1 billion must pay the greater of their tax liability, or 15% of AFSI under CAMT. That's a mouthful. Generally, OB3's new provisions reduce a business's taxable income, but they don't affect AFSI. In fact, they widen the difference between the two and can potentially subject more businesses to CAMT. In addition, although CAMT liability generates a CAMT credit, many taxpayers won't be able to use that credit now or in the future, whether that's because they continue to be considered a CAMT payer year after year, or because of general business credit ordering rules. Now, corporate minimum tax dates back to the Tax Reform Act of 1986, and the idea behind it, which is that corporate taxpayers should pay at least some income tax every year, has remained popular for most of the last 40 years. But as we've learned from experience, putting an effective corporate minimum tax in place is more complicated and nuanced than it seems. Lawmakers want to stand firm on the notion that corporations must pay their fair share, but they also put a high priority on boosting investment within the United States, and they want to preserve popular incentives that are designed to encourage businesses to remain within our borders. So with those 2 somewhat contradictory goals in mind, they continue to layer one set of rules on top of others. and the result is an ever more complicated and internally contradictory tax code. So where do we go now? Taxpayers have received some guidance from Treasury on CAMT, but are certainly clamoring for more. And then there's the question of whether this is even a problem to be fixed, or is CAMT functioning like it was supposed to? We have an outstanding panel today to discuss and debate these issues. Let me introduce them. First, we have Monisha Santamaria. She's a principal in KPMG's Washington National Tax Practice. Next, we have Deborah Taro-Sakono, who is an attorney advisor at the Treasury Office of Tax Policy. We have Miles Johnson, who is a senior attorney advisor at the Tax Law Center at NYU Law. And we have Wade Sutton, who's the international tax leader for PwC's Washington National Tax Services practice. I want to thank you for joining us today. This is going to be a fun and engaging conversation, I have no doubt. So let's get started. So I think it was last week, Kevin Salinger, who's the Deputy Assistant Treasury Secretary for Tax Policy, recently spoke at the New York State Bar Association about how Treasury views the purpose of CAMT, which he said was to prevent aggressive tax avoidance among the largest of corporate taxpayers. He also spoke about the direction Treasury intends to take in implementing CAMT. So I'm very interested in the thoughts of this panel on what he said and how you view the purpose of CAMT. So Wade, if I could start with you, is CAMT a true minimum tax, or was it designed to be a specific carve-out for a very limited number of taxpayers?
Yeah, thanks, Karen. This is a hard question, and it's a little bit politically fraught because you're seeing a lot of criticism from certain corners of some of the regulatory output recently from Treasury. But I kind of agree with Kevin Salinger on this point that, one, the purposes of CAMT are not spelled out clearly because there is no formal legislative history, right? So you have to infer those purposes. And I would look to a couple of places. One is the statute itself. It is not just you take your financial statement income and multiply it by 15%. There are a number of adjustments made in the statute. And then there are several regulatory grants that make clear that you can turn off or adjust AFSI to defer to other policies in the code. And so one example is subchapter K for partnerships or subchapter C for corporations. So I do think that there's some acknowledgement that the tax should be tailored to go after something that is not just a literal, you take your book income and multiply it by 15. So what is the something? That's the really hard question. And you might look to, Green Book proposals from prior years. Like there was a Green Book for the 2022 budget that had a CAMT proposal in it. You might look to member statements, like Elizabeth Warren was a very strong proponent of a CAMT type proposal. And what they tended to say was, we're going after aggressive corporate tax avoiders who are exploiting loopholes. So I don't really know what that means. I mean, CAMT is very politically popular. When you ask voters about it, like 70+% of them are in favor of it. But when you get down to the brass tacks of like, okay, what are we exactly trying to shut down? That's where that's hard. So I think that's the fair place to have the debate about, if you're making accommodations for research and experimentation expenses in OB3, is that shutting down the loophole or facilitating the loophole? Or is that just a congressional preference that you have the authority to let CAMT defer to?
It's interesting. It is necessarily complicated. Miles, I want to turn to you and sort of ask the exact same question and get your thoughts.
Yeah, definitely. I agree with Wade. It is a hard question, and it the overall purposes are not totally spelled out. I do fundamentally think that even when you take into account kind of the adjustments provided in the statute, the grants of authority referencing, sub K or sub C that Wade cited, I think fundamentally when you kind of look at it all together and look at those statements that Wade was referencing and some of those other, extra textual, as it were, sources, it seems intended to me to function as a minimum tax primarily on book income. Now, there are a bunch of adjustments, sure, but I think for, when you bring in things like aggressive tax avoidance, as Wade noted, that's a phrase that's going to sound very narrow to some ears and very broad to others. And so it's hard to use that as the North Star for the purpose of CAMT, because I think in some cases that's going to make it sound like, well, it's a pure anti-abuse provision. It should only really target people doing really, really bad stuff and monkeying with their income in improper ways. I don't think when you go and look at, what those people who were saying aggressive tax avoidance or referencing loopholes, I don't think that's how they were viewing it. I think, for example, you can look at some of the reports that I think some of the reporting and analysis that kind of generated or what CAMT came out of. And while they talk about, aggressive tax avoidance, they then cite things like bonus depreciation or R&E credits or CARES Act carrybacks. Like, these are just things that any practitioner would say, well, that's not aggressive. You take bonus, like, that's fine. And so I think, how they characterize it and what they were trying to do sometimes gets muddy. But fundamentally, what I think, when you pile it all together, what they're trying to do is to say, look, we have an issue where, for these large corporations, book profits are being reported very high, and taxable income, for whatever reason, aggressive maneuvers, just taking bonus, whatever, is much lower. Let's construct a tax that tries to get at that. Now we're going to have to make some adjustments to try to make this work, and then politics come in, and et cetera. But I think fundamentally where that gets you, at least in my view, is it's a minimum tax aimed primarily at book income exceeding taxable income for whatever reason, however you want to characterize that.
I think that's a fair point. And it's kind of interesting, like we're saying that it's to prevent aggressive tax avoidance. And then in some ways that would suggest that all of these large corporate taxpayers are engaging in aggressive tax avoidance when they might seemingly be following the rules. They use tax planning that was available to them legally. So it's an interesting point. We'll have to see how it continues to play out. Manisha, before we get too far into any weeds on these provisions, can you walk us through a little bit of the main provisions in OB3 that interact with CAMT? And I know there's a bunch of them, so as best you can, walk us through what's out there.
Me too. So I think it's important to set the stage. As Kara pointed out earlier, the OB3 results in an increased risk that a taxpayer who is an out-of corporation pays the corporate alternative minimum tax. And the question is, why? Well, this is because OB3 provides many, many generous benefits that decrease regular taxable income. And generally, there's not a corresponding reduction in adjusted financial statement income that can't get income measurement. In some instances, there are changes that just decrease taxable income. And in other instances, there are changes that they get rid of a book tax disparity under prior law, which also works to increase the likelihood that a corporation pays CAMT. So let's walk through the four main provisions driving this. The first provision is Section 174A, which basically says that it said before CAMT, before OB3 and post TCJA, even though you get a book deduction for domestic R&E costs, you don't get an immediate you don't get an immediate reduction in your taxable income. Instead, they spread that cost over a number of years. OB3 changed this and allows for the immediate expensing of domestic R&E costs, and for certain costs, specifically costs incurred in 22, 23, and 24, you can deduct all of those costs in 25 or 25 and 26. So this creates a situation in which taxable income is lower than book income in 25 and 26. In any situation in which taxable income is lower than book income can cause a CAMT liability. For years after the transition years, the book treatment and tax treatment of domestic R&E are going to be the same, but the cushion that was provided by prior law, an unfavorable provision in prior law with respect to regular tax can drive a CAMT liability. So this change is something that is causing a lot of concern to taxpayers. The numbers are huge. We're going to talk about how taxpayers are reacting to this change and questions they're asking about what was intended and what Treasury may do with respect to the treatment of domestic R&E expenditures for CAMT. So that is one big bucket or one big provision in OB3 that is causing taxpayers to think a lot about CAMT. Does anybody have anything to add there, or I could go on to the next one since this was a fun discussion to have?
Yes, Manisha, I thought that was a great summary. One point to add is that in prior years, taxpayers may have had a CAMT benefit from the mandatory capitalization of the R&E expenses because it could result in taxable income exceeding AFC. Here, we now have the reverse problem, which we've seen many taxpayers come in and make comments on and request guidance. And so I think it's a great setup that you just formulated.
Thanks. And that is true. I think taxpayers are considering whether they got an actual benefit or just a reduction in MC. They didn't actually do anything because they weren't paying CAMT anyway. So there's complicated and unclear policy considerations at play. So the next big change is the changes to bonus depreciation rules. Congress has historically liked encouraging investment in the U.S. by allowing 100% bonus. The book treatment of depreciation isn't so fast. Book generally doesn't allow for 100% bonus. So this change decreases, this change meaning 100% bonus decreases taxable income in years in which a taxpayer places an asset in service. Rules in CAMT are such that a taxpayer follows the tax depreciation amounts for Section 168 property. So some might think, well, this is good. 100% bonus with respect to 168 property decreases both regular taxable income and AFC. And since this is a one-for-one reduction, why is anybody upset? I should be good. However, there are issues that arise in years after assets are placed into service, namely, financial statement income. The starting point for AFC, the book starting point for AFC, can be higher than regular taxable income, and this takes away a cushion that taxpayers had been modeling out and counting on previously. So taxpayers now are thinking about how bonus may be driving CAMT liabilities, and these taxpayers are well served by engaged in multi-year modeling to see if taking bonus is a wise decision under the specific facts. So once again, something that looks easy is made more complicated by CAMT. I think the big picture point to make here is that the tax code has gotten so complicated and so hard to impute what is best in a given situation. The taxpayers need a model, and they don't just need to model the current year impact of all the new laws and all the old laws. They need to engage in multi-year modeling and multi-year projections to guess what's best for them under their facts. The third change is the change to the business interest expense rules. Prior to OB3 and still after OB3, if a taxpayer faces a limitation on the deductions for business interest expense, they get a CAMT cushion. This is because book allows the full deduction of business interest expense. 162J can limit the deduction, and when there is a limit for taxable income, there's a CAMT cushion, and that cushion can help with things like stock comp, because stock comp was treated very differently for book and tax. There were a number of changes to 163J. We're not going to spend the time going through all the changes on this panel because we would never get done with our exciting discussion. But basically, generally, but not always, the changes make it easier to deduct business interest expense, so taxable income was lower. They changed. All these expenses have always been deductible for financial statement income purposes and just AFSI. So a cushion gets taken away in many cases because of this change, and thus the changes to 163J are driving some liabilities. This comes up less likely, less often than the 174 in bonus depreciation CAMT impacts, but it's still a big driver for some taxpayers and something that needs to be considered. There were a number of changes to the FDII rules as well. And these changes, like the 163J changes, generally make it more likely that the taxpayer can deduct FDII. This is not always true. There were both pro-taxpayer and FIS changes to their regime. And once again, this is driving this is taking away delta between AFSI and tax and driving liability. So lots of changes. They're not always simple to understand. They require modeling out facts over multiple years to figure out what's going on. But basically, at a high level, that because OB3 reduces taxable income and causes differences, it causes a smaller difference between book and tax, or a larger difference between book and tax. Otherwise, OB3 is causing CAMT liabilities. I will point out that there's a silver lining to this, and I remind my clients of the silver lining all the time. That if you've gotten yourself into a position in which your regular taxable income is so low that you're paying CAMT, you're in a better position. This is true when you can use your CAMT credit. It's even true when you can't use your CAMT credit because the CAMT rate is 15%, the regular tax rate is 21%. So remember the silver lining and be happier in this cold, snowy weather that most folks are experiencing. With that, I'll turn it over to my fellow panelists to see if they have anything to add, since I walked us through a lot.
It is a lot to go through. I'll open if anyone has anything to add in. Otherwise, we'll jump to back up to Section 174.
The only thing I'm curious about is going back to the bonus point, because I think I don't know. I suspect a number of people might say, well, but there's a depreciation adjustment to AFSI built right into the statute. We don't even have to wait for guidance on that. So bonus fixes shouldn't create, a deviation between book and tax because the statute already allows you to. And so I think the points you were making illustrate that there even where the adjustment is very clear and in the statute, there can be a lot of nuance to this for people to figure out, right?
Yes, and I think the point there is that it works okay-ish if a taxpayer is placing the same amount of bonus eligible assets into service every single year, but because the world's complicated and taxpayers don't do the exact same thing every single year, there are years in which the higher capital expenditures, it doesn't always work out cleanly. And also CAMT generally doesn't have transition rules, and because the rules weren't always the same, you can see things like bonus where the regular tax and CAMT treatments are look to be the same, drive CAMT liabilities.
So we got an audience question in that is maybe somewhat related, which it says, so does CAMT depreciation follow the 100% 168K bonus depreciation, or do we need to adjust to a different method such as book? Can anyone venture a response to that?
I mean, I'm happy to take a shot, but I think subject to the things Monisha was just saying in response to my point, this is kind of the point. I think generally it does follow the statute 56A C13 has an adjustment to AFSI, i.e. your CAMT income, for depreciation taken for tax purposes under 167 on 168 property. And so the general rule is your bonus under 168 for tax purposes, you do get an AFSI adjustment for that. the nuance, and so, the nuance is then beyond that, there are some of the, factual questions Monisha was alluding to, is like that it doesn't always line up perfectly. People are doing different things in different years. There are timing adjustments, et cetera. But that's how I would think about it as a general matter, is that it does fall 168.
That makes sense. So let's turn back to section 174. So we've had some rumors that additional guidance might provide relief to the 174 issue. So if that happens, Miles, I'll turn to you to start with. Does that allow for what amounts to retroactive R&E expensing from the AFC amount to a new tax benefit for taxpayers?
Yeah. So, right. So the issue here is the first point that Monisha started with in the list of adjustments, which is OB3 allows for expensing of domestic R&E in a way that wasn't the case under TCJA. And so it also, as part of that, provides this transition rule whereby taxpayers can elect for regular tax purposes to deduct previously incurred, i.e. pre-2025, but not yet deducted, i.e. unamortized domestic R&E expense, immediately and effectively in 2025 or in 2025 and 26. And so that itself is, before we get to CAMT, it is a tax benefit for retroactive R&E in the sense that it is accelerating a deduction. It's providing a deduction for a faster deduction for expenses already incurred in prior years. The CAMT overlay is that people who make that election then have a larger tax deduction in, say, 2025, but there is not an AFC adjustment for CAMT purposes for that deduction. And so, the question is, well, does this, rumored / more than rumored likely guidance at this point that's going to provide some sort of CAMT adjustment for that catch-up deduction, does that provide another new tax benefit? I think, undoubtedly yes, right? Because that's why people are asking for it. You got a lot of taxpayers asking for it because the point is, well, if I elect for tax purposes to take this accelerated deduction of my previously incurred R&E expense or some of my previously incurred R&E expense, that's not going to affect my CAMT, and so that tax deduction is going to diverge my book from income from my tax and push me into CAMT. And so I think providing relief from that result, it is a tax benefit, i.e. it potentially or does eliminate a CAMT liability that the current the changes made in OB3 don't do on their own. The result under OB3 is taxpayers could be pushed into CAMT as a result of taking that deduction. So from that sense, I do think it would provide a new tax benefit for people, and I think that sort of is indicative in how many people are asking for.
I think it's important to note that it is arguable that Congress intended Treasury to do something here. There is a transition rule in OB3 itself with respect to 174. So I think it's important to note that Congress may have possibly thought about this issue and definitely provided Treasury with some leeway in this space.
And I'll jump in here too, because this has been such a hot topic issue for taxpayers. We've received so many comment letters and have participated in so many meetings with taxpayers and advisors on this issue with respect to the incentives that Congress passed as part of OBBBA. Many of these taxpayers and advisors view the results of CAMT liability as circumventing the intent of Congress in passing those incentives in the first place. And so we've been evaluating this issue pretty extensively internally, as well as evaluating our grants regulatory authority in CAMT. Fortunately, we have around 15 or so grants regulatory authority within CAMT itself. And we are hoping to issue guidance with respect to this issue.
So one thing just to react to the conversation, not everyone agrees with my framing of CAMT as preventing loopholes and tax abuse, but I will point out that what is going on here is that people were doing the opposite of what CAMT is trying to combat. They were deducting things later for tax purposes than they were for book. So undoing that, just getting people back to par, is arguably a little bit punitive because you're just putting people back to the same place they would have been had they followed book all along. I view this as it's really just bunching too many deductions in a single tax year. The other thing I would point out, it's funny, this guidance doesn't exist yet. I don't even know if it's written down on a piece of paper, but it's already receiving a lot of incoming criticism. One version of that criticism is, hey, you talk all the time about 174. You want to incentivize research. Well, this is retroactive, and taxpayers don't have time machines, so it's not going to do anything for their past behavior. By the way, the flip side of that argument works too, that retroactive tax increases are arguably really efficient for the same reason. I think the argument here that Congress would make is OB3 is just delivering on a promise that we were pretty clear about, at least on the Republican side and tax writing committees. Because of the limitations of budget reconciliation in 2017, this was not a permanent benefit, but that was always part of the core message. And so, like the extension of the look-through rule in 954C6, I think a lot of taxpayers expected this to become a permanent feature of law and acted accordingly. And really, it was like an accounting exercise for most folks as opposed to changing their behavior.
It's really going to be an interesting issue, and we'll have to do another webinar once the guidance comes out, and then we have something actual that we will get to talk about at the time. Deborah, do you view the impact of immediate expensing of amortized R&E differently from the consequences of immediate expensing on a go-forward basis?
Yeah, I think that is a very interesting issue, and there are different concerns with respect to those issues. So stakeholders who have come into Treasury generally have expressed concern regarding the CAMT consequences that result from the impact to regular taxable income for 2025 and future years from the continued amortization of domestic R&E costs that were capitalized in prior years, 2022 through 2024. And our understanding is that those concerns generally wane or decrease once that amortization period expires, because from that point onwards, the treatment of costs for these R&E costs for regular tax purposes and for book purposes is the same. They're generally expensed in the current year. But we also have become aware that certain industry-specific book rules may require more capitalization of R&E costs compared to other taxpayers. And we're also aware that certain software costs are required to be capitalized and amortized for book purposes, and that can create a book tax difference. And so we are continuing to study those issues and the differences between the two.
Miles, get your any reaction to that?
I think that all makes sense. I agree with the way Deborah characterized it. I think, and my understanding is the same, by the way. And the other two panelists should chime in if not. I think we'd all be interested to hear, but is the same in that it is a transition period issue, an issue of bunching of deductions, as Wade said, in that I think once we're past this, going forward, the R&E expense by and large, it is immediately deducted for book purposes. My understanding is that's most industries, but I am not a gap expert. And I recognize there are all sorts of nuances, and I'm sure there are industry-specific issues. But I do think that sort of means that the simple way to think about it, maybe oversimplified, is like on a pure go-forward basis, this isn't really so much of an issue. Book and tax, if at least for domestic R&E that can be deducted currently for tax purposes, for that, book and tax will largely line up. No CAMT issue when book and tax lines up. And so we're really talking about this immediate near-term kind of issue where you're correcting in one way or the other, where, book went first and now you're catching up tax, as Wade said. So.
Yeah, that makes
Well,
sense.
I'll interrupt here. I think one can't underscore how important industry-specific book rules are in creating CAMT issues. I think nobody on this panel understood much about book pre-CAMT. I think we've all tried to learn a little bit about the book treatment of various amounts in the last couple of years. And I will say that I continually get surprised at the number of exceptions to exceptions. And these exceptions to exceptions and special rules are enormous, to have an outsized impact in driving CAMT problems and liabilities. And I think we can agree that random exceptions to exceptions in the book rules were the main cause of concern that Congress had in enacting CAMT. So I think, thinking about it from a policy lens is important here, because we can say this exception only applies to 1% of taxpayers, but if the 1% of taxpayers have 10% of the problems as a result of an exception to exception in some book rule that none of us had heard about yesterday, there are policy concerns on the table.
The exception to the exception is why we all have jobs, right?
Of course.
I was going to say, this is making book rules sound just like tax rules.
Full employment
Yeah, but it's the complexity that. Sorry, what did you go ahead?
I was just going to joke, it was a full employment act for people who understand book or tax, and definitely both.
Right. That's right. So, Deborah, let me come to you with sort of a different type of question. Taxpayers are coming to Treasury for a lot of guidance, and there are instances in which Treasury can provide guidance that helps taxpayers, whether that helps them with their tax liability or just helps them understand. Are there limits to the ability of Treasury to provide that sort of help and relief to taxpayers?
That is another great question, Kara. I think there is at least one practical limitation, and that is that Treasury cannot exercise its regulatory authority to override the statute. And it's a pretty easy concept. It can be difficult in practice. One example that I've heard you touch on earlier, Kara, and Manisha might have mentioned it as well, is the ordering rule in Section 53. And that can impede a taxpayer's ability to use the CAMT credit if the taxpayer also has significant general business credit or GBC carry forwards. So as you know, or as a little bit of background, GBCs can offset approximately 75% of your regular tax plus your CAMT liability. And if a taxpayer has a CAMT liability, it has a CAMT credit under Section 53 that can be carried forward indefinitely, but it can only be used in certain conditions. So specifically in a future year, the regular tax liability reduced by GBCs must exceed the tentative minimum tax liability for that CAMT credit to be used. And in many cases, that may just not be the case. If it is the case, the CAMT credit can only be used against the delta or the difference between those two amounts. We understand and we are well aware that this can have very significant financial statement impacts for taxpayers if the DTA related to the CAMT credit is neutralized by valuation allowance, and you've probably seen that in the press. So we do continue to study this issue and take it very seriously. One thing to note is that unlike certain CAMT code sections like 56 Cap A, Treasury and the IRS do not have a specific grant of regulatory authority under Section 53 to issue guidance. And it's unclear whether Section 7805 would provide the requisite authority. So we may be limited regarding whether we can issue any guidance under 53 that would address these comments and concerns and requests. But as I mentioned, we're still considering it and thinking it through.
Excellent. That's very interesting. Monisha, as Deborah was just alluding to, the ordering rules for using CAMT credits can limit their usability. Taxpayers can model it, but are there ways to proactively affect their ability to use CAMT credits?
So I think taxpayers are thinking about a lot of things in the GBC CAMT space. There are a couple random points I want to make. First, the fact that you use your GBCs before your CAMT credits is not always a bad thing. A GBC can expire, a CAMT credit cannot. So some taxpayers are seeing situations where expiring GBC credits are converted to CAMT credits with an unlimited life, and this can be a good thing. So it's not all bad news. So I'm going to do glass half full again. When taxpayers think that their CAMT credits are going to be unusable and they need to take a valuation allowance, and because of the presence of GBCs, some of these taxpayers are thinking about their GBC generation and GBC purchasing activities. So taxpayers who have historically generated a ton of GBCs or purchased a ton of GBCs might not do the same. I think this is creating thinking and discussions in the industries that tend to generate and sell GBCs, because there might be changes to the GBC market or for the GBCs that are sellable. So there are things to think about. However, most taxpayers who find themselves in perpetual CAMT payer status and have GBCs are coming to terms, and I would say are in one of the stages of grief over CAMT and GBC usage. I know Wade has experiences here too, so I'm going to let him jump in if he's different.
Well, it's funny that there are certain types of companies that are heavy users of business credits, like typically in the financial industry. And there are others who, for whatever reason, they may not have a lot of credits, but their regular tax liability is never going to be that much higher than their CAMT liability for a number of reasons. And for those folks, they are pulling every lever they can to stay out of CAMT.
And, I think we haven't touched on the fact that the CAMT regime as it exists today has a ton of optionality and flexibility in it, just because there's no binding guidance and there are many options as to how to read the statute and what notice and proposed reg provisions a taxpayer applies. So I think that's where a lot of taxpayer focus is. And
That makes sense.
And that's something else that keeps all of us overemployed.
Right. Of many things. Well, I want to make sure we get to some of these notices that have been issued and address those. So, Wayne, let me turn to you for notices 2025-46 and 49, which were released last fall. Could you just briefly describe the notices, and then have they helped with taxpayer struggles? And if so, in what way? And I guess if not, in what way as well?
They've definitely helped. Let me tell you about them. And I actually want to start with 25-49. Because the really important thing here is under the proposed regulations in 2024, if a taxpayer wanted to adopt the CAMT regulations early, it had to do so consistently across all related entities for all open tax years. And I think that scared the heck out of a lot of taxpayers because it was a 600-page reg package and they had no idea what they were signing up for. So a good example, so I practice international tax mostly. There was an often talked about double counting issue where you would tax a CFC's earnings when they were generated and then potentially under the statute a second time when they were distributed. And I think that the proposed regs fixed that. And I think a lot of companies welcomed that. But when they realized, oh, shoot, if I rely on that rule in the proposed regs, what else am I signing up for? It was a hard conversation. So what the notice does that I think is most important, 2025-49, is it says you can pick portions of the regulations to rely on, and you don't have to rely on everything. Now, there's some, I'll put an asterisk next to that statement. There are some exceptions here, but for the most part, that means if your issue is double counting, you can just pick on that piece of the rules and rely on it and not have to rely on the pieces related to like partnerships, for example. The other interesting thing that notice did, one of the huge drivers of CAMT liability that doesn't get talked about as much is the book tax difference from 197 amortization. So this is like if I buy a business and there's a lot of goodwill associated with the business, or I make a 338 election on a target, you'll get an intangible asset for tax purposes that you amortize and deduct. That does not happen for book purposes. And so the notice with respect to pre-CAMT goodwill adjusted AFSI for those amounts. And that was kind of interesting because it did not apply. I think the date was October 28th of 2021, which is basically the introduction of CAMT. So it doesn't apply prospectively, but it was pretty important. The other notice that you mentioned, I'd summarize it this way. CAMT and the proposed regulations was a really complex hybrid of corporate partnership consolidated return rules and book accounting rules. And depending on if you had boot in your transaction or it was completely tax-free, you could go down various different analytical paths. And I think it was confusing to taxpayers. And because we are mostly tax people and we understand, the subchapter C rules or consolidated return, what the notice did is it basically says, use tax rules, but just substitute CAMT numbers and leave it there. And I think for most of the practitioner community, they sort of breathed a sigh of relief and said, oh, those are rules we know how to use, and that makes our life easier.
I will say that using CAMT numbers in it is something that causes a lot of headaches once you start trying to do so.
Fair.
Right. But we also should thank Deborah and her colleagues for all this guidance to start with.
A lot has come out, so we should be thankful. Manisha, let's talk about Notice 2025-28, if you would, which provided some new elections and methods for calculating AFC from partnership investment under CAMT. Could you briefly describe the notice and did it help? And what do you hope for in any subsequent guidance?
The Notice 25-28 dealt with certain partnership issues, specifically the liability inclusion from a partnership for when a taxable corporation holds a partnership interest. I will point out that CAMT is hard. CAMT is much, much harder than normal when a partnership is structured. A general complaint in the tax world. The statute can be read in multiple ways as to what is the correct inclusion from a partnership. We could spend an entire panel discussing this. In fact, I have many times. The proposed regs came up with a system that was described as a bottoms-up system, meaning that the partnership had to do a lot of the computations, and it's a string of tiers. Information had to be passed up through multiple layers, but partners also had to do a lot of work, notably figuring out the correct percentage. The tax community and taxpayers found those proposed regs really complicated and really hard to comply with, and there were also many concerns about information reporting. Notice 25-28 adds 2 or 3 new options as to how you compute your distributed share of partnership AFC amount. That's the inclusion with respect to a partnership investment for CAMT purposes. After Notice 25-28, there are at least a bigger dozens worth of ways to figure out your partnership inclusion in AFC, more than 13 ways. means lots of choices. That flexibility can be good in terms of, getting to a better answer, but it doesn't mean that it's easy to figure out what's best in a specific fact pattern. In fact, I think it makes it harder to try to figure out what's best. But taxpayers are grateful for the additional options, and I think it's worth spending a minute or two on two of the additional options. One is called the top-down election. One is called the taxable income election. The top-down election at a high level allows a taxpayer to use 80% of the book number that shows on the partner level financial statement as the inclusion in AFC. The only partners who can do this are Applewood Corp. So it has to do it at the top tier Applewood corporate partner level. That 80% of book income number is not an 80% of an existing book number. It's 80% of a modified book number. So it is still complex, even though it sounds like you just use 80% of book. Furthermore, in order to apply the top-down election, taxpayers need to figure out their CAMT outside basis, the CAMT basis, and the partnership interest. And there are a lot of questions there. So while it seems simpler, and probably is simpler, there's still a host of complexities at issue when taxpayers make this, seemingly simple top-down election. So taxpayers, I think are still hoping for more guidance on how to actually do this. I think they're hoping for guidance on the CAMT outside basis issues, and are frankly hoping that, the need to compute CAMT outside basis goes poof in future guidance, since it's so hard. So that is, one of the main new ways you compute your partnership inclusion post Notice 2528. There's another election that Notice 2528 provides, and that is the taxable income election. It sounds like you can use your tax pickup from your partnership instead of any book-based number. Once again, it is a number that starts with that sounds like it starts with an existing number, but actually isn't an existing number. So you can start with the tax number, but you make a series of adjustments. And you also need to compute CAMT outside basis and use that outside basis, CAMT outside basis, to apply a loss limitation rule. So once again, sounds simple, but the devil's in the details. But taxpayers are generally happy with the notice guidance to date. Notice 2528 does a lot of other things, but with 9 minutes left, I think we should move forth and talk about other interesting issues.
Yeah, I will just jump in to mention one point, and it's really interesting to hear that feedback, Manisha. I am by no means a partnership expert, but before the NPRM was issued, I know we had many different taxpayers come in about how to determine a partner's distributive share, and they asked for different things. Some asked for bottom up, some asked for a top down. There were some that wanted to use a taxable income number. In the notice, we allow the optionality for all of these different methods, and it's helpful to know some of the challenges that you're facing as a result of that notice, despite flexibility.
And I think people are very grateful for the optionality and flexibility, and the fact that more methods have been endorsed. But I don't think dealing with a partnership in the CAMT context is easy today. I don't expect it to become easy.
Yeah,
It's never easy.
yeah. Flexibility is always kind of flexibility is always kind of a double-edged sword, right? Because and I think we've seen a lot of reactions to this notice saying, as Manisha said, well, this is helpful and favorable, but that doesn't necessarily mean it's easier. Like with the amount of options there, both on its face, I think on its face, when you read it, it's like, it provides 3 options for calculate, your distributive share. But then, as Manisha has noted, and you can go read some of the things she's written, in reality, once you put together the statute, the prior proposed reg package, the notice, you end up with many, many, many more options and possible options, depending on how you read all those things. And I think, there can be I assume there can be sort of a bit of a paralysis of a choice paralysis there, where it's like, well, we got to model everything and figure out what the optimal approach is. And that's just I imagine a huge use of resources and a huge amount of complexity, because even when you model it all with that many options and that many interactions, I have to imagine it's the case that it's still not necessarily clear which option you should pick, because then, the proposed regs might come or are going to come later. But when are you, how long are you locked into whatever you pick? Considerations like that, despite sort of flexibility seeming favorable and being favorable in many ways, it's I just want to echo that it's certainly not always simpler. And, one other thing about this notice, just real quick, is that I think is really interesting. And if you want to tie it back to like where we started with like the purpose of CAMT and some of these, what it means, what some of these reg grants mean is, when you look at the partnership notice, it's kind of notable to me anyway, that you have multiple elections that sort of, subject to the nuances, a lot of the nuances Monisha was explaining, kind of just take opposite approach. You have one option, the statute, which in my mind, by using distributive share, seems to contemplate some sort of bottom-up method, i.e. you calculate the distributive share and you flow it out. The notice sort of says, well, we're going to offer a top-down that is more book forward. You just, again, subject to a lot of nuance. You look at the book, you take 80% of it. We're also going to, at least for some people, offer a pure taxable income where, you just follow it. And like, those are on the opposite ends of the spectrum when you think about CAMT and what it's doing. One is using it, at least primarily focusing on tax. One is primarily focusing on book. And it sort of illustrates I think the difficulty in how broadly or narrowly some of these reg grants or some of this purpose of CAMT language should be read, right? Is there leeway to provide elections that kind of go fully in opposite directions or largely in opposite directions? And again, like we started with, and like Wade said, I thought that's a hard question to answer. And I think people are coming out in different ways. But I think, to me, the partnership notice sort of it wraps all that up in it with the amount of options and elections it provides in the directions they go. So it's sort of worth noting, I think.
Yeah.
I think those are very interesting observations about how, multiple options can create more complexity, not only for taxpayers, but also from the government perspective, when, our next task is going to be drafting another set of proposed regulations to make sure that all the pieces fit together, and with the different options and the different elections. And, Monisha, you were mentioning earlier that under the book rules, there are exceptions to the exceptions, and then that can create a CAMT liability for certain specific taxpayers that might have a good policy justification to not be exposed to CAMT liability in that scenario. Providing relief for those taxpayers, which we have in certain cases already, it adds rules, correct? It makes that 600-page reg potentially longer. Hopefully it will not be that long. We are aiming to be shorter. But I think that some of the points that you're making about how options and elections and special rules being contraries at times to simplicity is a good point.
And I think one of the takeaways from the CAMT regime as it exists today is that this was supposed to be a simple tax because for some reasons Congress didn't trust the current measurement of taxable income. So they wanted a different number. Like, you can say that is a policy reason for passing any minimum tax. We are now in a world in which we have a set of very complicated rules with a lot of flexibility and then to determine the CAMT income measurement. And, that is hard for taxpayers. That is also helpful for taxpayers. So I think we're going to see this push and pull between, creating a number where there are book components and tax components, and there's also choices as to which rules you use based on which guidance you use. And I think that's, that is a gift to taxpayers, but it's also a huge burden placed on taxpayers and on the government. So I think that's what we need to watch for in the next months as we, all eagerly await new guidance and then more new guidance and then re-proposed regs and hopefully final regs at some point.
I mean, without a doubt, we are in that place where what was seemingly simple gets added on top of existing rules, and now we've got something that's complex. And the more options we put out there will just increase the complexity in many ways, even if on their own they were quite simple. On the upside, that gives us all a lot to talk about. It gives people a lot to write about for tax notes, and we'll have many more good conversations. I want to thank all four of you today. This was a fantastic conversation. I learned a lot. I always do on these, and I appreciate it, and I know the audience did as well. Thank you for joining us, and we look forward to the next one.